let's talk about earnings right out of the gate, because that has got to be number one. FactSet, if you haven't heard of them, go check them out. It's one of the sources I use for earnings information. They do a wonderful thing and a wonderful job of summarizing the earnings, and you can read it every week for free. It's where I'm going to give you some of the quotes from today, or I'll read it for you and I'll give you the highlights. All right, you ready for it? According to FactSet, and this was on Friday, their report on Friday, Earnings Insight, 21% of the S&P 500 has reported their earnings so far for the quarter. That's right, 21%. The number's a little larger because we kind of look at it in a greedy way and say, well, Goldman Sachs and these banks tick up, or they lead the company. Remember, 500 companies out there. There are a lot of them that report before and after. Earnings season just wound down a couple of weeks ago from the previous quarter, but 21% are in the book, so a fifth of the S&P 500. Of those, 68% of those companies have beat their expectations. Now, as we say that, or their estimates, as I say that, the 5-year average stands at 77%. Start to pull some data from this with me. A lot of people will read that 68% and go, wow, that's awesome. It's much more than a majority. It is less than the much more of a majority that have happened over the last 5 years. Earnings are 3.8% better than what the analysts are estimating. So remember, when we go through those numbers on what the analysts' expectations are and how they've been high, Disney, $170 on price and earnings growth and all of that, this is the number that is reflected in that. And the earnings right now are 3.8% on average. And that is far less than the average over that same 5-year period of 8.8%. Think about that 5-year period for just a second with me. And remember that we've had a pandemic over that period, but we've also had an amazing lead into that pandemic as stocks were on a rail higher before we hit that 2020 period. So you got 18, 19, 20, 21, 22 in this right now. Good, bad, pandemic, etc. And for what it's worth, pandemic right now, year-over-year growth, there was a point there where there was a surge. That last bullet point is one that I watched the closest, and that is the number of companies that are giving forward guidance versus forward positive, I should say, versus forward negative guidance. This is where the companies come out and say, here's what we did this quarter, and here's what we think we could do next quarter. Only one have out of those companies in the S&P 500 company or index have come out and said things look like they're going to get better, while 10% or 10 of them have said things are going to get more negative. That is not sentiment, folks. Sentiment is me asking you if it's going to get better. These are companies that are looking at their numbers, their trends, and saying, yeah, things are going to get a little tougher right now. So from an earnings perspective, we'll call it 5,000 feet on earnings right now. The report card is not great. The ratio is going to gain steam over the next couple of weeks as the analyst community. Man, I can't get these analysts straight today, Brandon. They're going to start playing catch up. Watch what happened with Snap today. All of a sudden, the analysts get a surprise, and we saw it with Disney as well, which was a great trade for us. They're going to start playing catch up and dropping their expectations, which means you see price targets coming down, and that's when the rest of the lemming in the market start to jump off the cliff and sell their stocks. That's why we're seeing a little bit of confusion in the market today over last week's route higher and then closing on that weaker note. People literally don't know what to do.